We are with Richard Tartaglia. What is this, video number 3 with you?
Number 3.
Is it number 3?
Yep.
Feels like it's more. Hey guys, what's up? It's your man Pete, and I've got Rich T back on this episode, and today we're going to talk about interest rates. I think everybody wants to know what's going to happen with interest rates for the rest of the year in 2018, and maybe let's project a little bit out into 2019 and see what we think the Bank of Canada is going to do, which is obviously going to affect your pocketbooks and your mortgage. We'll talk with Richard right after this, and we'll see you on the other side, guys. It's starting to rain, eh?
Yeah.
Richard Tartaglia of the Vine Group is going to talk to us today about interest rates. Basically what has happened in 2018 and what he thinks is going to happen in 2019. And we're going to talk about how this has affected the real estate market over the past year. So Rich, thanks for coming back on the show, man.
Thanks for having me back.
It's always great to have you. So we've had, what, 2 rate increases this year?
Yep.
And it was the first year of the mortgage stress tests for people with 20% down as well, right? So how has that affected the mortgage market and lending?
So mortgages have continued to increase, aside from just, new purchases. So new originated mortgages have decreased, but this year we did see 2 rate hikes. One right smack in January to start the year off, along with the 20% rate increase.
Which I felt was a little too early, considering we had the stress test already. Like you kind of want to isolate things, right, to see what's actually going to affect the market.
Yeah. So the Bank of Canada has 8 points throughout the year that they'll do those rate hikes. Actually come up with a decision on the overnight rate lending rate. And then, so we saw one in January, we saw one in July. Basically every mortgage as of January this year was being stress tested, and that had a big factor on new mortgages for people that could qualify. You basically qualify for 20% less.
Would you say that had a bigger impact than maybe those 2 interest rate hikes? Or?
Definitely.
Definitely
in terms of new originated mortgages, people getting into the market, first-time home buyers, people looking to refinance, definitely had a big play on what happened in the mortgage industry. Although mortgages were pushed out to private lenders and alternative lenders, we saw a big shift from mortgages being, your conventional bank to go out to your B lenders, your alternative lenders. So people who needed to get the deals done for whatever reason didn't care about the interest costs or setup costs for those types of mortgages. So a lot of deals went that way. Most recently, we had the NAFTA. So there was a lot of uncertainty around NAFTA for an entire year. There was threats of tariffs on auto exports to the U.S. Trump's been really kind of threatening, and most recently in October we did have an end to that, and we have the new USMCA agreement, United States, Mexico, Canada agreement, which puts a lot of certainty in our future. We have a lot more predictability to the Canadian economy, and with that, it is October 23rd today, we're likely going to see one tomorrow. That's what all the investors are predicting. And we're probably going to see 3 rate increases next year. That's what economists are predicting.
The smart guys, the smart guys. So why is it that we're expecting to see 3 rate increases? So again, we went through this long stretch of like what, 5 or 7 years or something of no rate increases. I guess that was in response to the financial collapse in the U.S. That's really what it was all about. And then now what, we're trying to play catch up, or we're trying to catch up to the U.S. in terms of like what's the difference between the U.S.'s overnight rate, benchmark rate, versus ours in Canada?
So ours right now is at 1.5%. I believe the U.S. is in the 2.5% range. In order to catch up to the Fed overnight rate, about 3 rate increases would be required to be in line with them by mid-2019. That's what is basically being predicted, that we're going to catch up to them. We're in an economy that is doing well. We have settled our trade agreements. We've seen steadily raising mortgage debt. We're at $2 trillion in terms of household debt. About 1.5 of that is mortgage debt, and we've had low interest rates for the last 10 years. So our debt load has increased as an economy. The government's saying let's try to decrease the debt load or have the economy stabilize without monetary policy. Which means that they're going to start to raise interest rates and sort of stabilize the economy. Because as an economy, if we continue to grow our debt loads, we're not doing ourselves a favor in terms of long-term growth.
There's 8 potential times where they can raise the rates, right? So tomorrow is potentially going to be one of them, right? It's fairly certain that that's going to happen. When do you think the next 2 rate increases, if you think it's going to be 3 consecutive increases, if you had to guess, when do you think they would be from a timing point of view?
Well, if we're catching up in mid-2019, then we're probably looking at maybe January, March, maybe June. I have no idea.
Well, it sounds like it's probably definitely going to be something maybe in the spring, right, of next year is what we're thinking.
Probably, yeah.
And you're thinking something early in the year, like January, like they did this year?
Yeah, probably one in January. They know how that rolls out. So,
which is a terrible time to do it because the market's already slow, right?
Yeah.
So it's like you're not going to see the impact of it, right? Like, yeah, it makes sense to do it in the spring, but I mean, I guess they've already decided and they're committed to raising the rates, right? So it doesn't really matter what time they're going to do it. They're just going to try to meet that benchmark in the U.S., right? I guess.
Yeah.
So if we're thinking 3 rate increases, are we thinking 2 1/4?
Yeah, probably 2 1/4.
2 1/4
see another one
by spring of next year, probably something like that. So then how's that going to translate into the retail market? So for people who are walking into the bank and getting a mortgage, or they're calling you to get a mortgage, how is that going to affect them? And how much more money is that going to be out of their pocket in terms of purchasing a property, right?
Yeah. So interesting survey that was done, an RBC article with analysis. There's a survey done on 1,000 homeowners with mortgages. They were asked the question: if you had a $400,000 mortgage with a 20-year amortization and your interest rate went up by 2%, they were posed 4 different options. What would your payment increase be if your mortgage payment was monthly? Only 25% of the surveyed individuals were able to answer it correctly. So
1 in 4 people can actually do math.
Yeah, I mean it's kind of a funny.
I mean, I'm in that 1 in 4 for sure.
It's kind of a funny. We're facing higher rates. We're facing an increasing rate environment, but yet we're seeing that borrowers haven't done the math. I think it's because they're a little shy to do it. They're shy to face reality.
Right. Yeah.
Consider a borrower that is 40 years old. When he was 30, he purchased a home. For the last 10 years, he's had low interest rates.
Like 2, under 2 kind of thing.
Low 2s, mid 2s, even on a fixed. Like you could get away with 2.5 on, or 2.49 on a 5-year fixed. That would have been the bulk of your mortgage experience as this borrower. So this guy's 40 now. His mortgage is renewing. He's now looking at rates in the 3.5% range. He's going to be looking at a higher out-of-pocket expense to just finance his mortgage. The data is going to reflect that, and I think that it's going to play a large role in how these rollouts, these renewals happen in the next couple of months, and that can have a big factor on the Bank of Canada raising rates too.
So how much more out of pocket are we looking at?
For an individual with a $400,000 mortgage, 2% increase in rates, that mortgage, let's say it's amortized over a 20-year amortization, that would increase the payment by $400 a month. The average mortgage borrower isn't aware of what the actual implications are for these rate increases. They haven't done the numbers, they haven't done the budgeting. I would encourage those of you who have mortgages, do the math, figure out if you can fit this into your lifestyle, and start cutting back now, living the decreased lifestyle.
Moral of the story: pay attention to your finances and don't be afraid to face reality, guys. Right?
Exactly.
So what are the options for people if they can't walk into a bank? So let's say their credit ratings, it's a bit on the edge, or they've got a bit of debt like student loans or something like that. Just anything that's going to affect them in terms of getting a conventional mortgage. What are the types of lenders that they could potentially go with that you might want to recommend to them?
Yeah, so there's every lender looks at things a little bit differently. There are still some lenders out there that are not stress testing mortgages to qualify.
Isn't it an OSFI requirement?
So credit unions are not governed by OSFI. So they're still qualifying on the contract rate.
Can you drop some names? Or
Meridian, Merix, there are not currently, and I think this is going to change very shortly.
So you've got a small window to get in there, guys.
Yeah, they usually do their own internal stress testing. Credit unions, like Desjardins, they do have a stress test, but Meridian doesn't. Merrick's doesn't. There is a bit of a rate premium on the contract rate that you're being offered to get the mortgage done, but effectively you're going to qualify for 20% more.
Oh, really?
Forget the stress test.
Oh, wow.
But there's higher rates associated with them.
How much of a premium?
So right now we're looking at around 4.29 on a 5-year fix. You could probably get on the same deal with a big bank lender around 3.69. Probably about
so like three quarter percent premium.
Yeah.
Okay.
So if you need the financing, rates are going to go up by that amount anyways in the next year or so.
So what type of person do you think would make sense to go with a credit union as their lender?
So someone who
self-employed or something like what category of people are we talking about here?
So really, it's just someone who's open to it. A lot of people just have their relationship with their big bank. They close their mind to everything else. They go into the bank, they get declined by the bank, and it's like mom and dad slapped them on the wrist, and now they're discouraged. So they stop the search and they stop the request for funds if they're refinancing. Or I think it should be considered by everyone. Everyone should know their options. That's why I prefer, and I usually recommend clients work with a mortgage agent that has a multitude of options versus just walking into the bank and getting declined by a bank advisor for whatever reason that the bank's declining. Yeah, but there's always options. It depends on what type of financing scenario you're in.
Well, so I think you mentioned that some clients are actually still going variable, right?
Yeah.
That's very interesting to me.
Yeah.
Can you give the rationale behind that?
So variable is a great product. When you take a variable rate mortgage, your exit strategy is very open. You have a 3 months interest penalty to break the mortgage. You can always flip the mortgage into a fixed rate with that financial institution without a penalty. If you want to move from one financial institution to another, you can do that and take advantage of what's on the market. So you're not just tied to that institution. You have a lot of options throughout the 5 years of a variable.
Yeah.
And maybe in 2 years' time, variable rates come down. It's not about what rate you get to begin with. It's the average rate that you have over the lifespan of the 5 years.
Right, yeah.
We don't know what could happen in the next 2, 3, even 5 years. There could be some global crisis that happens. It has to have the Bank of Canada come back and start to reduce rates. I've seen some individuals also go with like 10-year fixed mortgages just because they're so spooked by the interest rate hike. So it's really a risk tolerance question, and are you willing to risk your cash flow for it? But a variable rate option should always be discussed. But if you're the type of person that wants to have a fixed rate and sleep at night with that set mortgage payment, go with fixed.
Okay, so in my 8 years in the business, I've seen it a couple of times, right, where the market's, it's been pretty good trajectory going up, ever since I've been in the business. But there were moments where there was uncertainty about the market, and then what we started seeing was the big banks, because the market is slower now. Yeah. So and of course the banks depend on mortgages to make money, especially now. So if the transactions are down, new underwritten mortgages is down, do you think we'll start seeing competition in the space of the big banks, trying to, woo customers?
So there's a couple times throughout the year that the banks really come up with aggressive rates. They usually are around the springtime with the market to increase competition for those mortgages because there's a lot of transactions happening. People want to move in the summer. Yeah,
they want to please their shareholders, so you want to do it as early as possible in the year, right?
Exactly. They also want to end really strong if they haven't had the year that they wanted.
Yes.
So usually banks' fiscal year end is October 31st, like TD, Scotiabank. So they'll come out with very aggressive promos at the year end, and we saw that this year. But with talk of tomorrow's rate increase, they cut that short. So we only saw that through about halfway through October. Okay. We can pretty much predict when the big banks are going to come up with aggressive offerings. Yeah. But their policies are very, very tight. They're very heavily regulated. Yeah. So as far as offering policies that are going to draw new business in, they're really looking for the cookie cutter clients. 800 plus beacon score credit, really ratios in line. Right. Everything's kind of served up to them.
Cookie cutter, perfect. Great analogy. Who do you think is the most aggressive in terms of the big banks and in terms of wooing business and cutting their prices? Who do you think is out there to get business? Scotia? Or?
I really like Scotiabank. Yeah, I worked for Scotiabank for 5 years. I know how they operate. They operate in the broker channel as well as in the retail banking channel. Right.
Very aggressive. Yeah.
Yeah. They have very open terms. Come up with some very great rates. They have a very good flexible readvanceable product, the Scotia Total Equity Plan. TD is also a really great lender. Sometimes they'll come up with very low rates.
BMO as well. I remember BMO being quite aggressive early on in my career. But
BMO's aggressive. RBC's quite aggressive. CIBC has a very...
RBC, really?
So they have more strict prepayment privileges. They're more for like, they'll bend the rules for people buying a primary residence.
Okay.
But they don't deal in the broker space of RBC. Neither does CIBC, so they're not as aggressive. Neither does BMO. They don't offer mortgages through the broker channel. They just do it through the retail channel.
Okay, gotcha.
Which means that when you're dealing with the retail channel,
super cookie cutter.
Oh yeah, super cookie cutter. You have to pay to house those retail branch locations. The salaries, the housing costs. We know real estate prices have gone up, as opposed to the broker channel where they just pay the broker a set commission, and they forget about all the other overhead.
So quickly, in terms of the credit unions, who's most aggressive? Who really wants your business?
So Meridian has the contract rate, qualifying of the contract rate. They're very aggressive. There's a lot of talk about them removing that. Merrick's and Lendwise they're a monoline lender. They're not governed by OSFI, so they're basically offering the same sort of service. Bit of a rate premium. Meridian's very aggressive right now, though. Okay, so
best 5-year fixed right now and best variable rate right now. What is it at right now? What's the best?
So if you have an insured mortgage, you're putting less than 20% down. You can get as low as 3.19 right now.
Oh, okay, that's really good.
On a 5-year fixed. Okay. You should be looking at prime -1 for a variable for an insured mortgage as well. When you have less than 20%, you actually get better rates.
The 10%ers, right? Kind of thing?
The 10%ers, 19%, 18%, anything less than 20%, you're going to get a better rate than you would if you had more than 20%.
Oh.
Because from a lender's perspective, the mortgage is insured. So the losses are protected from the lender losing money on it. Okay. So they're willing to give a lower return on the mortgage as an investment.
So for the 10%ers, what's a monthly premium that you're going to be paying on, let's say, $400,000 mortgage?
So it's 3.1% of the entire mortgage balance. Right. 400,000. So on 3% on 400,000 is probably.
I'll let him do the math.
Around 13 grand or so.
13 grand.
Or around that, yeah, probably 13 to 15 grand. That gets added to the mortgage, and then they just pay the whole thing down together.
So what's the delta? What's the difference per month for somebody? How much more are you paying?
Probably 10%. $50 more a month.
$50?
Well, you have to take a 25-year amortization when you have less than 20% down.
Okay.
You can take a 30-year if you have 20% down or more.
Oh, okay.
So that amortization piece is a larger spread. You're probably looking at that mortgage, probably a higher payment of about probably $200 more.
Oh, I see. Okay. $200 more per month.
Per month, mostly because of the amortization.
So you were saying that if the fixed interest rates you can get as low as what, 3.19 right now, right?
Yep.
So if what we're predicting or what we're hearing from the Bank of Canada that we're probably going to have 3 rate increases, that's pretty much going to bring us to 4% for a 5-year fixed, right? Pretty much going to get there, right? We're going to see a 4, right? So it'll be interesting to see if this actually plays out in the next 3 to 6 months, and how that's actually going to affect people and affect the real estate market. My thinking is that if we haven't had a lot of rate increases for a long time, and then all of a sudden you start getting rate increases, it sort of brings a shock to people, right? And that's sort of where we are right now. It's like we're still sort of in shock. We're still uncertain about what's happening in terms of the mortgage, in terms of the interest rate increases. But my feeling is that once people start getting used to the rate increases, they'll probably start coming back into the market. It's always that initial shock that has a delayed impact on the market, and I think that's sort of where we are right now. I mean, the rate increases could potentially prolong that feeling of fear and shock and uncertainty, but there's also moments where we've seen where the rate increases are expected, people know about it. That's sort of why we're doing this video, right? If we can give people some sort of projection out into the future so that they can better plan and prepare. Face reality, guys. Don't be afraid to face reality, okay? Then you can do your math properly, you can calculate appropriately, and then you can work with your agent to figure out what the best property is for you in your budget range, right? So this is what the show is all about. This is what the channel is all about. It's about giving you information so that you can prepare and think better instead of being the 3 out of the 4 people who can't even do the math increase, right? So if you want somebody to do your math, talk to Rich T here. He's gonna get it done for you. But if you want to find the home, then you want to give me a shout. And let's try to finish the year strong, guys. And we hope this video provided a lot of value for you, not just for the rest of the year, but going into the first quarter or the first half of 2019.
Yeah.
So thanks for being on the show, Rich. As
thanks.
always, fantastic. You get better and better every time I have you on. And
I do a monthly or semi-monthly market update.
Right.
Shoot me a quick email if you want to be added to the list.
Okay.
I'll add anyone on.
And if you have any questions, by all means, contact Richard, contact me, send us an email, send us a text message. That usually works best,
right,
so that we can get back to you at the right time, so we're not responding to you when we're driving.
Thanks for having me on again.
Yeah, appreciate it, man. Thanks a lot, man. So it's gonna be an interesting next few months to see how things are gonna play out. But hopefully buyers won't be so spooked anymore, and they'll be sort of prepared and ready for these increases. So until next time, guys, thanks for watching. It was really jam-packed full of information, this one, and we'll see you in the next one. Bye for now.